That was a perfect spot.
Perfect. But before we got cut off, I was about to say, you're Italian. All you do is put it in an envelope and just say,
Yeah.
yeah.
You got a little silk purse I can put it in.
Yeah, exactly. Everyone now is wondering what the hell we were talking about. Imagine something and then make it worse. That's what we were talking about. Welcome to Tradiers. It's Trader's Edge. I am Jim Murio. That's Bob Iacchino. If you've been above the ground this week, you've noticed that markets kind of all hell broke loose, particularly on Monday. Things have kind of thinned out a little bit since then. We make fun of the TMZ of financial stations all the time and how they're always markets in turmoil. Okay, we like to look at it more as a logical, calculated, reasonable person about what we're supposed to do. But this is the time where we bring in technical analysis. That's why we have Mike Arnold coming on in a second. Robert, what do you think? Do you think the bloodbath is over?
Well, what drives me crazy, and I know you said that tongue in cheek, is this bloodbath talk, this whole, look, this could end up being an extended downdraft. It could. But when we're down 8 to 10%, depending on the index that you're looking at, it's a correction. And we get 1 to 2 of those every year. But these financial stations you've talked about, we won't mention CNBC by name, but they're one of them. They love to absolutely just go, oh, you know, there's blood in the streets. There's all this stuff. It's like, guys, calm down. It reminds me of when they talk about crime here in Southwest Florida, in the big cities, they exaggerate it. When they talk about weather disasters, when I'm visiting up north in Florida, they exaggerate it. So that's why you should be watching us. You should be on the Tradier Hub, watching us on YouTube, because guys like us and Mike Arnold will take you through it.
That's why we do what we do, because there's a lot of bullshit that goes on there. This particular show, we are going to have on Mike Arnold, who's an absolutely fantastic strategist. We are going to be talking about broad equity markets, S&P, NASDAQ, gold. We're also, toward the end of the show, going to break it down to some individual names: SMCI, NVIDIA, VST, CEG, Eli Lilly, Micron. By the way, I read those off because you had texted them to me. I don't know what SMCI and VST
are. You got Super Micro.
Oh, I do know what SMCI is. Yeah, and what's VST?
What?
What's VST?
Vista.
Vista. Okay, are we gonna do the rapid fire comments before we bring Mike on, or no?
Yeah, where are those comments? We got some rapid fire ones, and we'll get to some of these with Mike. Some of them are just ZERP comments with Steve. We love Steve.
ZERP again forever.
ZERP again forever. ZERP would do wonders for my hard assets. Even Japan recognizes their error in raising rates above zero. That's more ZERP. Tim, we can ask Mike this. I think Mike can hear us right now. XHB Home Builders. He'll take a look at it. And markets in turmoil. Hello to Patrick, by the way. And then Steve says Warner Brothers is crashing now. I got to look at Warner Brothers. Huh. I don't have a Warner Brothers chart up. I'm about to. So
okay, good. All right, well, let's bring Mike in. Mike, by the way, this is a special show because this is our version of markets in turmoil. Although we don't think it's in turmoil and we don't think the sky is falling, but we are going to bring Mike Arnold in to break things down for us. Mike Arnold, who is the chief technical analyst for Path Trading Partners and someone who has made me a lot of money over the last 2 years. Mike Arnold. One of the things we also like about Mike is he's intermittently gets kicked off of Twitter like once every couple of weeks. So it fits so nicely in with the rogue persona that we were trying to craft for ourselves. Thank you for being here, Michael. Nice shirt.
Hey, thank you. And I haven't been kicked off in 2 days now.
That's fantastic.
By the way, the Warner Brothers is crashing now. They're up 1.8% on the day. So, but they're down from their highs. Not really.
Steve may have led us astray on that one.
Steve was being tongue-in-cheek as well, I think.
Okay, good. So should we hit a little bit of macro talk before we break down to the first chart? So, okay, it's one thing to say, valuations are stretched, which they were. The rotation, big tech into the Russell, which seemed until today to be still intact. Mike, do you think that if the Fed comes in and does what Steve just joked about and starts putting massive liquidity into the system, will this be enough to turn around, or is it just all about the technicals?
Historically, if things start slowing down and they start slashing rates, I mean, if they just start cutting them 25 basis points at a time. We're going to just continue probably to grind lower as the curve, the 10-2s go higher. It's just the way it sort of works. Now, if they were to go ZERP, I feel like you remember those Dow 10K, Dow 20K hats? I feel like I need
rates zero.
a ZERP hat. I need a ZERP hat because
you're getting a ZERP hat, my friend.
By the way, ZERP is zero inches.
In
case there's someone out there going, what the hell is ZERP? I remember it from years ago. But yeah, that's where we're at here. Do you guys want to head right into the equity markets? We'll go to S&P right off the bat.
Well, I want to throw two more comments up. One by I'm not sure I'm going to say this right. Demos Capital. We're the clowns that advocated for a rate cut in a market that's up 10% year to date with a 4.3% unemployment rate at 2.6% inflation. Now, those may be headed in different directions in the coming months. But again, the emergency rate cut, the three of us talked yesterday and we laughed about that. And then we've got, and actually, Jim, I want your opinion on Steve's comment here. 10-year U.S. Treasury auction today was a D+. Do you want to comment on that?
Oh, yeah, it was a crappy auction. And you guys know what I've been saying for a long time is that I thought that we were going to get to a point where the longer term auctions weren't going to go as smoothly as they were. So now of the last, call it 8 months, probably about 60% of them have been fine. 40% of them have been sloppy as hell. Now, what was interesting about today's auction being sloppy, think about what we're talking about. We're talking about markets in turmoil, worry all over. Normally, U.S. Treasuries are the thing that people want to increase exposure to in those times, and they didn't particularly today. So I think, is it a sign? Yes. Is it the end of the world? No. But it is something to put on the ledger of, are we getting to the point where global demand is not going to be the same for U.S. longer-term bonds, and those rates are going to go higher? And I've been talking about a steepener and intermittently have had it on and taken it off, for the last 6 months and made some okay money on it. I think it's interesting. But by the way, the Demos Capital too, if you heard us yesterday, it was so funny. On Monday morning, and again, it's easy. The psychology and the emotion of all this shit is so easy to succumb to when everyone's like, emergency rate cut, emergency rate cut. And there was even moments on Monday morning where we're going, yeah, emergency rate cut. And then there'd be like 2 minutes later, like, what am I talking about here? I mean, GDP is still positive. I believe in the recession more so than these two guys do, I think. And still, I didn't think burning timbers were falling from the ceiling.
Also, Widge has a comment here that I want to throw up. We have a regulatory and spending problem. I can't see how rate cuts will help either of those. You have, we're in complete agreement on the screen here, Widge, I'm pretty sure. The spending and regulatory problem. And then lastly, Demos Capital again. He says that I love you guys, and he says I don't. No shots taken at any of you. I don't think any of us took that as a shot. I want to make sure I wasn't saying the name wrong. That's number one. Number two, feel free to take shots. We think it's funny, but we didn't take any of that as a shot.
Not at all. Okay, let's talk about shots being taken. Let's talk about the S&P. I just dropped my computer on my foot. Sorry about that. We're so professional here.
So you ready? That crapped out in the rally a little earlier than I thought. I mean, we hit a couple key levels today and just then rolled over. And it was sort of an ugly afternoon in the S&P. But
I thought so too. Yeah.
So
can we get a chart up? There we go. Yeah.
I mean, there was a little. Again, I've been talking to people, and I favor the short side right now. If it's a long trade, I have to use conservative targets, which means my targets are brought in because unless we close above some very key levels, I got to stay bearish at least until we form a longer term bottoming pattern, which could happen in the next couple of weeks. But are we there yet from a probability standpoint? We're not there yet. Now, anything can happen because probabilities are only probabilities. But we're not there yet from everything I follow.
So tell me this, when you see the last 2 days, and one thing that jumps out at me is those incredible rejections and rolls over both of those days, those long wicks. I know yesterday we ended up closing positive on the day, but not just barely. And today we rejected it and closed south. To me, that is a powerful negative sign. What do you value it as?
It started to break up. It was stair-stepping higher. Hit the first key target from this little head and shoulders. hit it. Then we hit the second one. What was interesting is it pretty much nearly filled to the closing bar gap, and then from Friday, and then just crapped out and broke a lot of the key support. Now, we haven't broken the key thing that I'm really watching based off today's price action yesterday, because it's been rejected in waves from that key resistance area, is if we start closing below 5209, at least when I want to see it follow through on a 4-hour close. I'm not talking a 5-minute close. But if I start seeing that tomorrow, then we should definitely, from a probability standpoint, retest the 5150s. We break below that, and we have some magnet prices down below. There's a harmonic cluster. There's the 200 SMA on this continuous chart, which the last time we really were dancing in that area was the bottom that was formed at end of October, beginning of November. So I would not be shocked to see us possibly test this 5,000 to 5050 area. I'm really keying on a 5,050. We have probabilities. We have a harmonic cluster there, and that's what I'll be watching for. Should we take out Monday's lows? Is that the end of the world? No. Again, that's where I couldn't get over the fact that people calling for 75 basis point emergency cut when you're still up. You'll still be up a bunch of percent on the year. It's not disaster yet. Although this market is weaker, especially it's been proven out the last couple of days, a rally can't get going. It at least attracts a lot more selling than people think.
So tell me this before, real quick, Bob.
Yeah,
I
go.
know you had the next question. What's the level on the upside that makes you think all is clear?
If we do not take out Monday's lows, it's 54.95. Just remember 5,500. 5,500 on a closing basis, not an intraday. Because even if we were to rally up to between 54.20 and 54.95, that's a very key rollover. Based off this price action from the last 2 days, that's getting tougher and tougher without first retesting the low area from Monday.
I want to point something out to everybody. So we had Mike on our other podcast yesterday. Okay. And that has not come out yet. So if you're watching this live and you don't see you don't want to subscribe to the Futures Head podcast on YouTube or Rumble or any of the podcast platforms, I'm putting this out for a reason. As yesterday, I asked Mike, this was yesterday near the close. I said, are you more in the camp of selling rallies or buying dips here? And he very clearly answered without hesitation, I'm more in the camp of selling rallies, which is why we wanted to have him on this live show, because this selling rallies is exactly what's playing out. I want to jump, if we can, Mike. Let's jump to the NASDAQ. And then if we can, I don't want to ignore Tim's question before the show even started as to whether you had any opinion on XHB, which I know you don't mind doing analysis on the fly. But let's look at the NASDAQ first. Which to you feels weaker, or does either feel weaker? Is the 200 representative of something here?
Well, we've already hit the 200 on the NASDAQ, which is the first time. I mean, we were dancing with it in the 200 area. We really flirted with it at the last October lows. And then the time before that was March of 23 lows. So we've already had a substantial correction. What's interesting today, and we're not officially closed yet in the futures, right, but unless this gets some move on in the next 40 minutes, we could, in the NASDAQ, close below Monday's low, Monday's snapback low, which would be fascinating to me, because then the NASDAQ, again, is weaker and couldn't hold Monday's snapback rally levels. I mean, it didn't close higher. It still closed lower on Monday, but it was a pretty substantial snapback rally. You can see here, it formed a really nice double bottom, came up, hit 2.5 of the targets, filled the gap from Friday, and then proceeded to crap out, and also could not sustain, at least so far into the close, could not sustain a very key support level. The level I'll be keying off of tomorrow morning, and overnight with Europe is if we start closing below 17,808. So just remember 17,800, 17,800. We get a follow through 4-hour close below that, then that shifts the probability to retest the level of 17,350 to 17,500. If those levels break, let me just clear up the chart just a bit. If those levels break, then the next key area, and this is very interesting from a standpoint. If the next key area lower would be 16,900 to about 16,700. A close below 16,700 is really not good for the NASDAQ. Then the probability shift down to we could retest 15,000. However, there is major support. Even if we break this 200, it's good. It's going to do some technical damage, but this 16.7 is very key.
Interesting. Okay,
So
what else? Where does it recover on the upside? Where is the green light level?
The green light level, if we do not take out Monday's lows,
Okay.
19,621.50. So 19,620 area.
Right, which is mostly above that congestion that it fell from a couple of days ago, right?
Yeah, and by the way, if we do take out Monday's lows and anybody wants the new levels, they can just find me on the good old YouTube and ask me what are the levels, and I'll just give them to you. So if they break below Monday's lows and you want the new recovery levels, which means it's all clear to the upside, and that means we should probability-wise retest the highs, not necessarily break out the new highs, but retest the highs. Because remember, we don't have to. We can form a bottom down here and just stay in a trading range for a while. We don't have to rocket higher. We could just stay in a wider trading range, a very volatile trading range, but a wider trading range.
Makes sense. Bobby?
Can you go to the home builder, that
XLV?
XHB?
XHB.
Yep.
See what you think of this chart. And then I want to, while Mike's putting this chart up and getting it ready, JM Brewer sleeps. Has a comment that said, so markets go up on hikes and cuts now. And I think, Jimmy, this is a really good comment. And here's why I say this. People think that there's one factor every single day. This happens, so we go up. This happens, so we go down. And I've always said that market moving factors are more of a sort of unholy trinity of three things: expectations, normal correlations, and how those may be different right now. And the answer is essentially JM, in my opinion, yes. And the reason is excessive rate cuts give the market the idea that there's such underlying weakness that the Fed and the bond market sees that we're going to have really bad earnings. Rate hikes, it obviously is harder for companies to make money. Really bad earnings. Now, we didn't end up with really bad earnings from the hikes. We had some weakness, but certainly nothing we'd call really bad. Jim, you do agree or disagree?
No, I do agree. And I'll add something to it as well. I believe that it's so oversimplified to say markets like low rates or markets hate high rates. Markets like rates lower than where they think they should be, inorganically low. That's the Fed put. So if the Fed is slashing rates and the market thinks it's appropriate because all hell is truly breaking loose, then I don't see the market rallying off that. I think if the Fed starts to, if the economy hangs in, which I don't believe is going to happen, and the Fed starts lowering rates and the market can say to themselves, well, the rates are probably lower than where they should be. We never really had any sort of slowdown. Then I think the stock market will like it.
I used to get this from friends and clients all the time. They'd call me up and they go, earnings were great. Why is it going down? Because the market expected them to be better.
Yeah. Or market positioning. Too many longs.
Market positioning. So, which I think is almost the same thing.
It is almost the same thing, as I said.
Yeah, they're related for sure. Yeah. So, Mikey, what do you got here for our friend Tim?
Real quick, it could also be, companies can beat and give not as good forward guidance.
Yeah.
And say, hey, we still beat, but give it a couple quarters and it's not looking so hot for us.
Right. And in a weird way, that the Fed can do that as well. Like they can say, look, we're being cautious, but we think it might be appropriate to cut rates as we've seen. Now they haven't said this. I need to qualify this, but they could say as we've seen a substantial increase in unemployment and a slowing of economic activity, then the market will overreact the other way. So
Yeah. So XHB today, good day to actually look at this chart because it on a closing basis, and the closing basis is the most important print of the day. It closed below the key. This shifted the probabilities. It closed below 106.50, and so it just shifted the probabilities to with again, it's not 100%, but it's we've got very decent probabilities that we will retest something between 97.50 and $100.50. And right in the middle of that is the 200 simple, which it hasn't recon. You see how many markets are trading so similarly. Look at where we broke last time in November, the beginning of November, which set up the massive rally. And now, even in the XHB, we could easily reconnect over the next few weeks with this key 200 area, not just because it's a 200 again an area, but the probability shifted. Now, longer term, let's take a look because that 50 EMA, there's a reason I watch that because it tests out very, very well. But if that's broken, if you want to really know in the short term where it's completely kiss home builders goodbye, it's about $89 on closing basis. So we could pull back definitely. I would not be aggressively looking to buy home builders on these pullbacks without some kind of significant bottoming formation. Or you know what? If they go ZERP, then it changes.
ZERP changes everything.
ZERP changes everything.
That up right now. Michael, I got a question for you though. So yesterday it closed below that level. Or was that today? Whatever that was
today. Today it closed here.
Below your key level. Why was that a key level, by the way? Is it the 625?
It's the 62.5, which is and why is that so key for people who don't follow what I do? Because one of the major support zones, let me switch this line on to a line on close chart. So one of the major support zones where you're watching for bounces on the way down would be between the 50 and the 62.5 harmonic. If we close below the 62.5 harmonic, not just trade intraday below it, remember, it's not like a rock solid wall, especially in something like an ETF, you can trade around that. But once you close below that level, it shifts the probabilities that the next highest probability is to retest the 75 harmonic. But really, it's not much lower that we go to the 87.5. So if you watch that, that's where I talk about the probability shifted because we closed below that level. So we did not bounce in the support zone. We got a couple little bounces. We could not recover at all and then kissed it goodbye. So I have to go with, in the short term, at least until I get a bottoming pattern, I have to favor to the downside.
Okay, so here's the question I was going to ask then. Tomorrow, if we see a print below the low, below that closed on the beat low, does that bolster anything, or is that just nice? You're right, but does it like bolster the probabilities in your favor?
No, the probabilities have already shifted. Now I'll be watching now on the strength of on the strength of bounces.
Got it.
Very small bounces with faster rollovers lend it to downside is getting downside momentum. If we start getting bigger bounces, then we'd have to then say, okay, let's be a little more patient. The only thing that shifts it, because I always like to analyze both sides, as long as we don't take out the lows from Monday, which is a probability what we will. But at this point, the only thing that could shift it is a close above 114.83, so 115, which is not looking likely at this point, but you always got to know when things could shift again.
Makes sense. Okay, good. Moving right along.
Yeah, let's start the list of stocks.
Sure.
Okay. You want SOCI?
Yeah, let's do SMCI.
By the way,
Hey, Ozzy in the background there. I'm going to send you something in your
for the
email.
record and for my lawyers who know that my licensing is very focused on futures and not on individual names, these guys are talking about levels. I'm asking questions. I make no recommendations to anybody there.
No, none of these are trade recommendations, period, because
Yeah,
probabilities are
we don't
not
know the depth of
guaranteed.
your pockets or your risk tolerance. This is what
Yes.
we're thinking about. Yeah.
And what you just said is very key, and I talk about it all the time. Just because you potentially have a setup does not mean you have a trade. Okay, because you got to take into account reward and risk along with the probabilities to get your trade expectancy. And if you don't have a positive trade expectancy, for me, there's no trade. So a setup does not necessarily make a trade.
Gotcha.
Period.
I'll tell you what I'm recommending on all of these stocks. Buy and hold for your kids on all of these. Go ahead.
What's the time frame on that one, Bobby?
50 years.
65 years.
Oh, are we going to be higher in 65 years?
Probably.
Yeah. My guess is yes. Actually, my prediction is yes. Go ahead and sue me.
Yeah.
Oh, boy. It's sue you in 65 years if you're wrong.
Right.
Or at least you're a state.
125. Right.
All right, SMCI. Here's a great example because on Monday we opened below that 62.5, but did not close. We didn't close on Friday, Monday, or Tuesday, but today, bon voyage. We also have the rotation zone heading lower. Where we've broken the 200. So this is another one. Rallies, I would be looking to sell. And the magnet price for this is roughly about 352. And look at where that 87.5 harmonic is. And if I look at the prior major breakout level, look at this. There's key resistance back in August of 23. Then it based here, if I can zoom in a bit, it based here. You see here this base in January of this year. Then it broke above it. We've had the run up, which then proceeded to break down, but stair-stepping lower, and that 87.5 harmonic lines up exactly with that. So that would be a key target area for longer-term pullback trades. Right down to there, the probability of the breakout. Could it go below that? Yeah, but that would be a key target area. If it did break below that, the base of this would be very, very key. The base right around 230, and which would correspond to the 200 weekly simple. So it doesn't have to go there instantly, no, but with an overhead rotation zone, meaning the 8 EMA and the 21 EMA, this orange and blue line, any bounces into those, I'd be looking for rollover setups and looking for shorts. Now, at least from a pure just price action, unless this can regain 710 on a key closing basis, I wouldn't be interested in doing anything besides minor, very aggressive bounce plays with very tight targets because the probabilities can just keep stair stepping down.
So here's a quick question: is that okay? I look at this chart and I come to the same exact conclusion as you do when it traded below. What was the 50% there, which was the low of that consolidation move right in there? No, higher.
Right here?
No, higher.
Here?
Just a little bit higher. When the consolidation since April broke, like I'd say, okay, this is a run up, a consolidation pattern, or whatever, maybe even a bull flag. But when it breaks, it becomes I don't know, it looks like a bear flag. And I would my measuring objective would be how low it went down into that channel, and then another equal play to the. Does that make sense? Am I describing right? Then another equal distance to the downside, which is right to where we are right now. But you don't look at stuff like that usually, right?
I do. It's that's a traditional measured move.
Yeah.
And we could go through, and if I was sitting down with somebody this was their stock that they were trading all day long, every day, this was one of their key things. We're going to do measured moves. You're going to take the width of this channel approximately was caught in. When it broke down below that, you're going to do the same measured move, which just by eyeballing it takes it roughly down close to 75% harmonic. Right. Which would give me a cluster here. So would I be shocked to possibly see a bounce even a bounce back to this 600 area, maybe even back to 656 before another rollover play? No, I wouldn't. Because just because the probability shift doesn't mean we have to be there tomorrow morning. You know, probabilities take time to play out.
No doubt. Bobby?
But this would not be one I'd be looking to. Okay, I got to be in it tomorrow. Look, it's pulled back. It's a bargain. I got to buy this. And you have on any bounce, you're below the 200. You'd be bouncing into a rotation zone. It's not the prettiest chart anymore. You've closed below the 50-week. The magnet area, even without harmonics, I look for the prior breakout besides the run-up. And this went pretty vertical up from January to March. And now it's, you know, it pulled back to that 50% harmonic, bounced a little. And one other thing, if you look here, if I do this little retracement from the bounce level, let me pull off these other ones because this I'm just putting this up right now. So on this retracement, what would have been the key level it had to close again above? 62.5. Look at this.
Look
right
at
there. What's the rollover zone? Between the 50 and the 62.5. Spike in there, roll down. Spike in there, roll down. Spike in there, roll down. Spike in there, kablooey. So that's why I come up with the levels that say, look, there could be minor bounce plays, but for me to have been, if let's say I was trying to buy the bounce, which dips on this thing, which I don't trade SMCI, but my key thing was if I was going to remain bullish on this, besides little bounce plays, it would have had to close above 1,020, which it never did. And then
you mean to say kabloom? Or you meant to say kaboom? You said kabloom, I thought, which I want to use that now. I like it. Is that
kabloom? There, it went
kabloom. Everybody says kabloom.
It's got a feeling you get when you get kicked in the nards.
Kabloom.
As Mike's switching to the next chart, I want to just address a comment from Steve, because again, we love Steve. Steve says, do we need a nuclear strike in the Mideast or Ukraine for oil to go back up? And I'm going to say this, and I'm going to get political here for a second. Part of the reason that I'm going to support who I'm going to support in this particular election, and you can just guess after my statement who that might be, is because there's going to be no way that the reduction of U.S. production doesn't fall into the lap from a public perspective of the next president. It's going to. And one president may have a little bit more influence over the Saudis than another one. So that's kind of where I'm going. Crude oil is going to rise as U.S. production falls. Now, does that mean that a Mideast flare-up isn't going to cause it to spike? Of course it would. But it would have to be a flare-up that actually affects production, not just talk, not something involving like Israel and Lebanon, which there's no oil in either place. So it has to actually affect a producer. And if it were to go in the direction of, well, you know, our production started tapering off and US production is tapering off, someone's going to have to go to OPEC and convince them to turn the spigots on. And they're the only ones who can actually turn the spigots on. The US can't do that. It's a different type of oil. It's a different type of production process. So we got NVIDIA here.
NVIDIA, which has been interesting today. Look at this. So you had Mondays, big gap down, rally, snapback rally, you know, because we had those non-emergency cuts. Today, we closed below. Remember, focus on the closing price. The intraday price action is great, but look at today's close. It's closed below Monday. We bounced into the rotation zone, rotated back down. Now, prior to that, we had formed a massive double top pattern. You can see it here on the weekly really easily. The massive double top. I just put the old targets back on, which on Monday's open, we gapped below the final target and completed that pattern. That means that pattern's done. What I needed to see was a close below the 62.5, which was exactly at $100. We did not do it on Monday. We bounced back up on Tuesday, and today we closed back below it. That now shifts the probabilities. It was already short but we completed that pattern. Now to start aggressively looking to further downside, I needed the next probability shift, which was that close below 100, which means my probabilities have now shifted that we can retest 8370 area. And if you look at that, it's roughly where the 200 simple and the prior major consolidation area before the last run up that caused the double top. So would I be looking again to be aggressive on the and buy every dip? No, but if we get nice bounce patterns, it could be potentially very short-term traded. The level at this point is 122. If this can't get a close back above 122, I'm not interested in looking at something longer term in NVIDIA until we get a substantial bottoming pattern.
So, but again, by the way, if I'm only half joking. If your time horizon is 65 years and you were saying, God, I wish NVIDIA would pull back to get in, have at it. That's not what we're talking about on this show at all. We're talking about near and medium term moves.
Right.
Cool.
Yeah. I mean, but things can, remember, on pullbacks, things can last, things can pull back a lot longer than people think.
No doubt about it.
Know your time frames also, because somebody who's buying a dip for like a 2 or 3 or 5 day play, it's very different than somebody who says, I'm going to hold this for the next 10 years.
Right. By the way, just a quick question. Were that line of today's lows and a series of highs lost it from before, right? So it's similar to the series of, and it came back through that. Is that an area of significance because it was a series of highs back in March and April?
This was significant because it formed again a very significant resistance shelf. This is one of the patterns I love for stocks, where we held right at that resistance shelf, and then it broke above it. So breakout above the resistance shelf, we tried to gap below it, and we've still held it on a closing basis. But that's something key to watch. Also, if you're trying to look at something in the short term, I'd really pay attention to that 95 level on a closing basis. So today we closed below that 100. The next key closing area, or the next key things, if I was structuring trades, the next important milestone would be that 95 area that you just talked about, Jimmy.
Makes sense. Yeah. Okay.
Hey, real quick, Demos Capital, you have a question for Mr. Iorio, which I don't know why anyone would call him that, about the national debt. Go ahead and ask your question, and when Mike switches to the next chart, Jimmy will go ahead and answer that for you.
I think he's going to get me riled up, but I think it's what he's doing it on purpose.
I think he is too. I love the guy. Absolutely love the guy. So what do we got now? I can barely see it. This is Vesta, right? Or
hold on. How am I supposed to answer the question? I thought it was going to pop up on the screen.
Well, he hasn't written it yet. He just says, I have a question for Mr. Iorio about
Shoot it, Emos. I can start ranting about the national debt right now.
Yeah. All right, so this is Vistra, right, Mike?
Yep, this is Vistra. Vistra, very interesting, because this is in the very key reversal zone, which is held and bounced. The key line in the sand for Vistra is 59.82. You start closing below 59.82, it's not good. We have not closed below it, so it's still holding key support. This 65.60 in the short term, I try to find a level between this 50 and the 62 harmonic that's very key. In the short term, it would be around the 65.60 level on a closing basis. Right there. I want to double check something. Just let me double check. It's very, very sloppy, but the only thing that would make me in the short term be substantially more bullish is if it closes above the high of 82.88. As long as that does not happen, I would still be looking for rollover plays until it formed a longer base between that 59.80 and that 69 area. If it formed a longer term base without closing below 59.82, then I'd be comfortable still looking for the long side. It would get a little iffy though if it closes below 65.60, because that was a very key support shelf that was formed back in April. So,
so question, by the way, we've looked at about 8 different charts, and basically everything is kind of the same with the upside. It has to get, I think it's like last Tuesday, maybe, whatever that high is, but on pretty much all of them, it was the same thing. It was the high on last Tuesday, and if we settle above those highs, that all the weakness is mostly invalidated, correct?
not from the SMCI or NVIDIA.
Oh, no, yeah, those two are different. Yeah, okay. I was thinking about
and why? Because they had already closed. If I jump back to NVIDIA real quick, you see NVIDIA's now shifted the probabilities lower. So it's not just getting above. It's not just getting above last Tuesday's high or whatever it is. It's getting now above this. It's got to shift it the other way.
Okay.
So does that mean? And people get confused. Well, I'm not going to wait all the way, for it to get up there. I'm not saying there can't be long trades, but in order for me to be sustained bullish, which means I'm shifting into a more sustained bull mode, any of a bounce plays have to get above 121.98 in NVIDIA. Otherwise, I'm still looking for rollover plays. If that makes sense.
Bobby laughing, which makes me laugh too.
No, I'm not laughing at that. I'm laughing at two things. Number one, Steve Goldstraw put a phonetic spelling for your name, which technically is incorrect. He put it up in English. He put Iurio, but in Italian, it's actually Iurio.
Yeah, right. But they like almost half swallowed it, Iurio, but like it's an EO, almost like an EO.
Iurio, like the first 3 letters make one sound. It's
exactly. That's pretty close, though, Steve. I'm going to give it to you. Bobby's very particular about pronunciations. I am a little more forgiving.
Eric says, "Oh boy, Tradier gave Pad Trading Partner the keys," which is kind of funny.
They'll regret it till the day they die, Eric.
Well, Mike, are you switching charts? Are you still on? You got more on this one?
Oh, just real quick. You see also, this is the weekly chart of Vistra. If we did close below that 59.82, we'd also blow the 50-week moving average. The key targets then lower. That would really be kissing Vistra goodbye. And the key target area would be around 31 to 41. So it could easily round trip back below. Now, we have not closed below that level yet, but that's why that's 59.80 is so key, especially on a weekly closing basis.
Real quick now, as you go to the next chart, I want to put up Demos Capital's question, which is long, but I'll read it here. I mean, I don't care how long it is. I'm happy to get a question like this. So, Ozzy, if you can put that up. I follow your lovely channel, and I see that you regularly talk about debt being too high and unsustainable. Considering that a significant portion of U.S. public debt is held by foreign governments, not really anymore, right? Corporations, what defines the point in which the debt becomes too high or unsustainable? Given this distribution of ownership, could the high level of debt be seen as valuable, since the failure of the U.S. would almost mean the failure of others?
So the mutually assured destruction thing, that's why nuclear bombs aren't going off too. That's what he's talking about here. I don't think it matters too much. What you're saying, I think, is interesting. I think a lot of people don't want U.S. debt to slip, but I think it's out of their hands at this point in time. I think they're spending like drunken sailors to the tune of $1 trillion every 85 days of extra debt. I think it's going to get to the point. Now, you asked the question, when does it get to the point? My guess is within the next 6 months to a year is that it becomes the debt service itself. Once that gets to 1.4 trillion, which I believe is the rough estimate for 2025, Bobby, does that sound right?
Yes, right.
Just the debt service, bigger than the defense budget. And then I think the auctions will go be a lot more slippery and a lot more sloppy. What I assume is going to happen, though, is that the Federal Reserve is going to come back in and stopgap the debt through buying it and quantitative easing. At that point in time, the dollar is going to suffer. Whether we see it in the dollar index or in the currency pairs is one thing. We will see it, though. We will see it in gold, silver, Bitcoin, eggs, beef, all that shit, because the dollar is going to be weaker. And it's going to be because of quantitative easing and boosting M2 supply. But your question is interesting about mutually assured destruction and how, but we already, remember, as far as foreign entities go, remember, we gave them a 30% haircut. We didn't even call them to ask if that's what they wanted. All of a sudden, we just took our long-term debt and beat the shit out of it, even though they were holding a huge amount of it. So it doesn't seem like we care that much about them. But do they care about us? Yeah, they don't want us to default, but we're just going to pay them back in cheaper dollars.
All right, I'm interested in this one a lot because it's Constellation Energy. By the way, guys, thanks for all the questions and comments
Yes.
today. Constellation Energy, people might be surprised, but it was I think, third or fourth best performer of the year in the S&P 500 in about like toward the end of June. So that's why I think this one is interesting. Go ahead, Mikey.
This one, there's nothing that says sell the rallies quite yet. You got a little pressure to the rotation zone, but again, Monday coming down, gapping open right around that 62.5, closing up. All these other closes were between the 50 and 62.5. We all had a prior little mini double bottom that again here's exactly what I talked about before. Just because you have it set up doesn't mean you have a trade. Set up, there's no way to execute this trade. It went beyond all the targets on a gap open. So remember, setup does not equal a trade. But what's interesting is we have not broken the 157.02. So bullish setups, still fine for this. Now, what would give me pause? If we start closing below 164, 164 is a key support shelf from back in March, middle of March. Also the area of the 200. We start closing below that, I'm going to sit up and take notice. We then follow through with a close below 157. It's no longer a potential bullish play for me in the short term because it probably means I don't trade Constellation Energy, but electric utilities, but it means something's really slowing down on here. And the magnet price would be this 125 area, which, funny enough, is right around.
Wow.
Notice how I get a kick out of technical analysis.
It's like magic. It really is. It's amazing.
Yep.
Now, has this what I just laid out all the way down here, we might never see. We could continue to hold. It could even pull back into this 50 and 62.5 again and continue some bounce plays. But if you're looking for bounce plays also, what would make it sustainable beyond short-term bounce plays, I need to continue and rally it back above about 206. I need it, which would also take it back above. So you see out here, over to the left-hand side in April, we had a key resistance shelf, broke above it, tested with an emotional candle, came back down, tested in June and held, tested in July and held. Then it broke.
Kabloom.
It went kabloom. Rallied up, kabloom. Rallied up, kabloom. So not only would it have to get above 198, you could just remember 200. That would be my early warning sign. Hey, we've regained the key resistance, but then I'm still going to want, from a probability standpoint, for it to follow through with a close above 206.
Okay, there is one of these names that I have an uncomfortable position in right now, and that's the last one on our list, which is Micron, MU, right?
Yep.
We have Lily too.
Okay.
All right, let's do Lily and Micron.
Oh, Lily as well, yeah.
Yeah, I want to say 5 minutes at the end of the show to read something to you guys from our friend James Fishback.
Let me get through these quick. Micron is all the way in yesterday's close, triggered it to, it was already breaking down earlier. You can see it's been riding rotation zone down. It tried to hold the 200. Yesterday it closed below 62.5. This is definitely a sell the rally to me. It's been sell the rally. Now it's even confirmed. We could see 62 again potentially. Next key target is a downside about 76 and then 62 on any down moves. It's done major technical damage. At least if before I could consider anything beyond like a micro bounce plays, it's got to at least regain 107, which gives it some minor support to lean against, but not much.
Got it.
That's just this is an ugly chart. And look where that 75 area is. If you take a look at the weekly, you have the prior key breakout zone, broke above it back last November, came back through December and retested and held, and then it went off to the races. And that's where the 200 week and the 75 harmonic. So in the short term, my magnet price lower would be right around that 76 area.
Would you, if you were short this and you had got short at good levels, would you cover around that level?
I'd be at least taking something off the table.
That's what I would have done too. Right.
There's
Okay,
a lot.
that doesn't mean because I still have magnet price down to potentially 62. It doesn't. It means, and we're going into a major support area. I'd at least, hey, I want some of my money. Give me some of my money.
Yep.
That's where I'd be at.
NASDAQ future is about to close right on their lows, essentially.
Oy.
By the way, Lily, you wanted Lily?
Yeah.
I want to go through this one because it's important. It's, we've had more so of these have been bearish plays or shifting to bearish. Lily's not there yet. Between the 50 and 62.5, you have the 50 EMA and you have a major support zone right around 718. Okay. And you have right around 730, you have the 200 simple. Now, in the short term, it's breaking down, but the major bounce zone is between 741 and 685. I'd shorten up that bounce zone to between about 741 and 718. You start closing below 718, I would be not so hot and buying the bounces, but the kiss it goodbye level 685. Until that happens, look, you're back in the consolidation zone. That doesn't mean any bounce plays have to rip higher. It means you're in a very key support zone for the time being. So this is another one that hasn't shifted to disaster bear mode. It's had some technical damage done, but it's still potentially playable on the time frame to the long side.
I think this is really important to point out because that sort of 685 level that Mike's talking about, that's like 11.25% away from where we're closing today. So this is technical damage versus, a crisis where we need a 75 basis point rate cut.
And just from the weekly standpoint, because I always multi-time frames is key. You can see that major weekly support shelf and the 50 EMA. I mean, there's the 50 EMA on the weekly basis. So that 718 level is going to be so key on a continued pullback. That's really what I'd highlight. And my spidey sense, if we start to close below that, would really, I'd be like, I don't know if I want to really be looking to buy dips so much anymore. I'd be looking to possibly more aggressively sell rallies.
Makes sense.
So real quick, I want to put up something that if you guys want a good Twitter follow or X follow, J_Fishback is a guy. He's a friend of mine and Jim's. He's on both of our shows a lot. And he's founder of Azoria Capital Markets. And he put up a tweet a little while ago, and this was what he highlighted from his last letter. The Fed's undeniable political lean makes an emergency rate cut and or aggressive rate cuts less likely for two reasons. First, if the Fed cuts aggressively, it could signal that there are hidden economic issues. Who asked about this earlier as to why I think it was J.M. Brewer. All right. First, it could signal there are hidden economic issues causing the market to panic. Investors and businesses would ask, what does the Fed know that we don't? It could suggest a real crisis rather than just market volatility, hurting Vice President Harris's electoral chances since she's technically the incumbent. I threw technically in there. And in the eyes of the public, bears responsibility for bad economic news. Second, it would open up a stellar attack line for President Trump. The economy under Biden and Kamala is so bad, the Fed has to cut aggressively as it did during the 2008 crisis. Jimmy and I both believe, I think Mike does too, I don't know if Mike's willing to say it here, that the Fed is a political institution. To you guys.
First of all, of course it's a political institution. They literally are appointed by the government. They serve at the government's, what do you call that? Serve at their behalf, whatever that expression is.
Yes.
Yes, exactly. That's what the Fed is. I'm sorry, they're human. If I had my way, we'd automate the whole goddamn process. We'd get about 20 different inputs. Mike Singleton, Mike Arnold, James Fishbach, these guys would all weigh in. We'd come up with whatever 20 signals we got. And the Fed
he didn't mention me.
Bob Icino, you and me we'd be the leaders of the committee. I'd have the gavel. And we'd figure it out. The fact that we have human emotion and tendencies in there is ridiculous, and it's just leading us to a bad path. Michael?
I've been beaten on the get rid of the Fed for years. I mean, I've been before Bernanke took over. I've been saying let's get rid of this and let's standardize some kind of automated rule set, okay? And it can be calculated. You know what? Or if you want to ban it completely, then let the free market decide it. But if you need something with inputs, at least standardize it and let's work with it instead of basing it off what people think. People are emotional creatures. There's no way to separate the Fed from politics. It's just not going to happen.
It's not going to ever happen.
Proclaim their independence. No, I'm sorry. No.
Right. All right. That wraps it up for this. By the way, want to thank all you guys for being here. I love this show. I love that it's live, and I love all the input you guys give. We can't tell you how much we appreciate it. Remember what Bobby and I are trying to do here. We spent 20 years in mainstream media. We hate that expression as well. We realize that even basic opinions on the most basic economic policies or different names and equities get influenced by producers and sponsorships. We are trying to create or build platforms that don't have those biases because it's all bullshit if you can't say what you think. And none of it works without you, the DMs, the retweets. We appreciate it very much. This has been Tradiers, the Trader's Edge. I'm Jim Muriel. That's Bobby Chino. That's Mike Arnold. Follow him on Twitter when he's not kicked off.
Thank you.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.